Stephen Koukoulas. Oh, should I say Koukoulas? Mate, here we go again.
Here we go again, Mark.
Yeah.
Wow.
It's sort of comes upon us sort of so quickly at the moment. And by the way, like, what a difference a couple of months makes.
Yeah.
And probably the thing we should just talk about at the top of the show is the Reserve Bank review, the independent review that was just recently released, the outcome. What do you think of that? Is it going to make any difference to consumers?
At the end of the day, not much at all. To just summarise, they're keeping the 2 to 3% inflation target, so that's unchanged.
That bothers me a bit, but anyway,
Yeah.
I'm just worried they didn't really give us much discussion about that.
They had almost no discussion about that other than it's sort of worked for the last 30-odd years, so let's keep it. The things are more procedural. There's going to be a specific monetary policy board who will make the decisions rather than the existing Reserve Bank board. So
Who's going to be on that board?
Well, they're saying monetary policy experts.
What's that mean?
Yeah, good question.
Put your hand up.
I don't know.
You're a monetary policy expert.
Well, Jim Chalmers, if you're watching, I'd love to be on the board. Yep. But, you know, it's people who've got financial markets knowledge, who know which way it works. So I can imagine that people from the financial markets would be on it.
Yep.
Academic economists, got to be a little bit careful because the Reserve Bank has 400 academic economists working for it. So in a sense, you don't need them to recheck the modelling and all that stuff. You need people with real world experience. And dare I say, people with knowledge of how the economy works, what will be the impact of rate hikes or rate cuts, or keeping them steady. That's the sort of thing that's going to be on the board. And the only other thing that is sort of noteworthy, instead of 11 board meetings a year, every month except January, there's only going to be 8 board meetings.
What's that about?
I think they're trying to avoid the problem that happens for at least 4 of the board meetings at the moment, and that's having a board meeting after the GDP numbers come out. So they haven't quite formulated this yet, but what they're going to be aiming to do, I think, will be to have a board meeting 2 weeks after each quarterly inflation number, after each quarterly GDP number. So they've got 2 weeks to analyse those numbers. Do we hike? Do we cut? What do we do with these numbers? Rather than first Tuesday of every month when, sometimes not much happens. So it's a bit more like the US system where they meet a little bit less often, but with probably a lot more information when they make their decision.
And this point, though, I've read through some commentators, and I think I also heard the Federal Treasurer talk about it, that there's going to be less influence of the Reserve Bank chairman or governor. That is, he's going to have less ability to influence the outcome, although he has denied that he does influence the outcome.
Yes, and yes.
Yes.
the Treasurer and even the former Treasurer, I think every Treasurer that I've been aware of for the last 20 years or more, says the RBA is independent. They make their decisions to hike or cut without fear or favour.
Independent of government.
Independent of the government. They look at the economic data, they make their decision for love or money. Sometimes get it wrong, but more often than not, they get it right. So what the review is also going to lead to is the fact that it's going to put in a more formal sense that the Treasurer of the day doesn't have, not a Labor Liberal issue, just the Treasurer of the day cannot override what the Reserve Bank Monetary Policy Board decide. That can happen. Now, it's never happened in the past.
I was going to say, he's never exercised that power.
Never done it. No Treasurer's ever done it since 1959, the Reserve Bank Act, which is going back a long time now. They've never done it. However, the possibility's always been there, and you never know what goes on behind the scenes. Saying, mate, if you do this, I'm going to override it. So you actually influence the RBA without actually pulling that trigger. So that's taken away. So in a sense, when we hear after this new system's put into place in the middle of next year, the Reserve Bank make their decision, and the government of the day says, look, it's not our decision. They did it. There'll be a stronger element of truth in that.
Right, but the people who are going to be appointed to the new monetary policy decision-making board will be appointed by the government.
Yes, indeed.
It's a bit like the US system where the government at the time appoints whoever the Supreme Court judges are, trying to influence the outcome of, really policy at the end of the day, although they're supposed to be interpreting cases, but they're influencing policy.
Sure.
Do you think, therefore, I guess the question is going to be, what's the term of these appointees and etc.?
Yeah, that hasn't been decided yet. I think the intricate details are still to be formulated. And yes, you're quite right. The Treasurer of the day or the government of the day does appoint it. So there's still this risk that this Monetary Policy Board has, people friendly to the government, let's just say quietly. But that said, if that friendly Reserve Bank Monetary Policy Board makes bad decisions, financial markets will punish them. Because if they make a decision that's obviously wrong, the markets will kick them in the tail. We'll see bond yields spiking. We'll see the Aussie dollar falling. So, governments, I think, have to be a little bit careful not to be too clever by half appointing mates to this board. We'll see, but I hope they don't.
Okay, let's move on to the real world now, mate. Yeah. So what data's come out over the last 30 days that we need to take notice of?
Critical one was the quarterly inflation data for the March quarter. It came in at 7% year on year, down from 7.8% in the year to December, which is clearly the peak. So it's sort of a good news, bad news story. The good news, inflation has peaked, it's starting to come down. The bad news, it's not coming down at a super strong pace at the moment. So we've got that issue of inflation, turning around. The $64 question now is how quickly it continues to decelerate. So we can talk about that in a minute. The other news that came out for the past 30 days was the labour market numbers were good. We had another strong lift in employment. Unemployment's still 3.5%. So even though the economy is slowing down, job ads are turning down, and anecdotes about the labour market is that there's some softening going on, not showing up in the official jobs numbers just yet. The other thing, I'm sure we'll spend time on this, house prices look to be heading up. Is it the proverbial dead cat bounce? But we know in Sydney, according to the CoreLogic numbers, house prices are up 0.5 for the whole of the country. Sydney was 1.3%. Other cities, 0.2, 0.3, 0.4. But clearly there's something brewing, and I think that's just linked to a shortage of properties and the fact that the RBA paused last month maybe just got a few people out of the woodwork.
And that's what that's what we mean by a dead cat bounce. Just a little bit of information has fueled a lot of people's optimism. But let's just go back to a couple of stages there.
Yep.
So let's just talk about inflation. So it came in at 7% headline. The underlying inflation number?
The underlying inflation was about 6.5%,
so that's
a little bit less.
Not much improved from last time.
No, only a couple of tenths of a percent.
Yeah, so it's and we've got a long way to go. Given, as you said earlier, they've confirmed the 2 to 3% range. So we've got to go from 7% down to 2 to 3%. That's a long way to go. And this is all going to go to the question I'm going to ask you right at the end. Are we going to change the rates, or we're not going to change the rates tomorrow? But given it's a long way to go, and given the unemployment number is still very low, it's not getting pushed up to where you and I thought the Reserve Bank would like to see it move up. What do you reckon? What do you reckon is going through the head at the moment? I don't want to go through your board. Yeah. We'll do that in a moment. But what do you think is going through the head? Do you think that maybe we should be doing something here and just cracking them once more, which is what they do in the US?
I think the Reserve Bank, and they've signalled this, they've given a lot of statements in the last month as well. We've heard the Reserve Bank governor speak. We've got the minutes of each board meeting, all those bits and pieces. I think they've got a bias, and we call it a bias to hike interest rates. So if there is a move in interest rates, it'll be up, not down.
Yep,
okay?
totally.
That's a pretty easy thing to be saying right now. But do they have the wherewithal, the information to actually pull the trigger on another rate hike? Because they do know consumer sentiment's pretty weak. We still have this uncertain effect of the mortgage cliff. That is, these fixed rate mortgages from 2 years ago, 3 years ago, rolling over as we speak. There's a whole bunch of them. A couple $100 billion rolling over this year, and they're rolling over to interest rates that are way higher than they were taken out. So people are being smacked on the head with this big increase in mortgage rates. Do they want to deliver yet another rate hike when these things are going on? And when another important thing that we've spoken about, I think every time we have our fantastic monthly meetings, is what's happening in the world economy. We know the US is slowing down. We know that Europe's pretty weak. The UK's very weak. China sort of had a bit of a post-lockdown bounce, but we just had numbers coming out on the weekend. They released the numbers on the weekend for the Purchasing Managers Index for manufacturing. Okay, so that's a big part in China, big part of the Chinese economy that's manufacturing, low-cost manufacture, dipped below 50. So it's actually signalling a contraction in Chinese economy. So the global economy's sort of
because that makes sense, mate. Because they're manufacturers for the global economy.
Correct.
So if the global economy is saying we're not going to buy as much as we normally buy,
we're weakening. It'll hit China, and then that feeds into commodity prices, and that feeds into Australia. So long answer. That's a long way of answering your question. I think the Reserve Bank will sit tight because they're just a little bit too wide over egging it. If they go one too many, They don't want to cause recession. As we just discussed, we're going to get a new Reserve Bank governor, probably, and a new Reserve Bank board very soon. Dr. Lowe, who's made mistakes, we've discussed those too, doesn't want to be the guy who pulls the trigger on a rate hike that causes a recession. That's just my view. And in fact, interestingly, the markets are pricing in a very low probability of a rate hike.
Do you think another rate rise would cause a recession?
It'd cause even more pain. It's one of these ones that proverbial straw that breaks the camel's back.
Yep.
We've had 350 points, 3.5% increase in official interest rates, and that's broadly being passed on to mortgage holders.
Yeah, but if we had 350 basis points of rate increases, how come inflation's still 7%?
Lags. I think it's taking a while to work its way through.
Can you explain the lag process?
The lag, yep. RBA hikes rates by 350 basis points. The first couple of hundred people think, oh, that's okay, I can cope with it because we were coming from such a low starting point. Don't forget that, well, this time last year, the official interest rate was 0.1%. So the first, let's say, 100 people thought, oh, yeah, bit inconvenient, but it doesn't impact me. Then it got to the point where a bit more and a bit more and a bit more. So then people realised, hang on, the bank's just told me that my repayments have gone up another 100, another 100, another 100.
A month.
It's got to the point now where it's in many cases $1,000 a month more than they were a year ago. And people say, okay, hang on, that is actually causing me a bit of pain. And it's interesting about inflation, Mark, is that is a cost of living issue. If you're forking out more money for your insurance, for your food, for your electricity, for all these sorts of things, your day-to-day living expenses, what is high inflation, then of course that's taking away a lot more of your money as well. So people are hunkering down, and that's an important thing. It takes a while for that to impact. Businesses have got to recognise, oh, my business is slowing down now, so I'm not going to put up my prices, which is how inflation starts to turn down.
So what is it though, given it was April last year, so what is it then in 1 year, that's taken 1 year, that has protected things turning around more radically in terms of affecting the inflation number or the growth of price of goods and services, and particular services?
Yeah.
So goods are behaving a lot better in the basket of goods and services.
Their prices are slowing markedly. It's services
at a faster rate than
insurance, hotels, airfares.
Okay.
They're the ones that are very
let's
elevated.
explain that part, because, when they come to measuring inflation, the ABS, Australian Bureau of Statistics, have a basket of goods and services, which, by the way, they choose. And most of us don't even play in that basket, or certainly not all the categories. There's
cigarettes and things.
There's a lot of categories.
Stuff like that's in the inflation numbers, yeah.
And this is also being experienced in the US. The goods, in other words, commodities we buy, whatever it is we might be buying, groceries or whatever it is, they're performing, or they're reduced. Their rate of growth is a lot slower than services.
Correct.
So the sorts of things you just mentioned that fall into services is, for example, travel.
Yep.
Accommodation. Is accommodation in there?
Yes.
What about rent? What about rent?
Dwelling rent is a service. Yes, right, it's not a good. Correct.
Okay, so
correct.
The influence of services on the total basket of goods and services growth, inflation, is probably a lot more than we've ever expected.
Correct. And in fact, it's this, what we call in economics the sticky part. It's not coming down. It's sort of sticking to the roof, if you know what I mean. What goods prices, you quite rightly said, and even things like petrol, while, and we've got to remember that about this time last year, shortly after the Russia-Ukraine war, that disaster, the oil price in US dollar terms got to about $120. We were paying $2.20, $2.30 a litre here in Australia. Okay, it's now $1.80, give or take. That's down. That is good, as in petrol, oil. Price of lettuce has got to $10 when the floods were hitting Lismore. They're back to, I think, $2 or so for a lettuce. So those goods that were impacted, a while back, and they're coming down in price. The inflation momentum's falling. Services prices. The thing about travel, accommodation, hotels, rents, those services are being impacted by factors that, in a sense, are outside the control of the central bank. The fact that borders have reopened. We've got hundreds of thousands of foreign students coming back to live in Australia. They're renting, these apartments that are near all the universities, pushing up the rents. It's a good thing for the Australian economy. However, the unintended consequences are that rents are going up. Holiday makers are coming into Australia. Our borders are open. Try booking a hotel in Sydney, Melbourne, Brisbane, the Gold Coast. I travel a bit with work. I tell you what, the prices I'm paying for nice hotels, and not the best 5 stars, but they're okay, are astronomical because they're selling them to tourists. Business people are going about their business again. So the
airports are still full.
Airports, yep. The planes are doing very well, and the airlines have bumped up their prices. They've come down a little bit just in the last little while, but airfares are much higher now than they were pre-pandemic.
And also taxis and Uber and everything else. They're
Correct.
all
all
business.
These services, and that's a function. This is the critical thing, Mark. I think we've come the circle. The critical thing that's linked to the tightness in the labour market, the fact that unemployment is still 3.5%. We are 0.1% from the unemployment rate being at a 49-year low. A good thing, I want everybody to have a job. But when we've got unemployment so very, very low, it's hard to find workers. So what do workers do? They ask for more money. They ask for better conditions. They jump jobs relatively quickly. And that's that I won't call it not just wages, because some of the other labour costs come in. Firms are paying, if you stay until Christmas, we'll give you $1,000 or a couple of $1,000 at the end of the year. So it's not really a wage issue. They just don't want their talent to leave their business.
Well, I was talking to someone this morning who's had one of his restaurateur, they had one of his talent or one of his staff poached for a much larger amount of money than he was paying this particular individual. And then this particular individual then went and tapped a few of the other staff on the shoulder and took them with him to another establishment. So, yes, this sort of stuff is happening out of desperation because we don't have enough people here. Yep. So, to some end, how do interest rates solve all that? Because increased interest rates don't really solve those things.
And this is where we get back to that thing that we often hear about. Interest rates are a blunt instrument. They crush the economy to stop the aggregate economy from growing as quickly as it was, so that businesses cut their prices or don't increase their prices as much in the future. So in a sense, it's that, come hell or high water, because the rate hikes are designed to slow the economy. And when the economy slows down, inflation does fall. It does take a little bit of time for it to work its way through. But the interest rate hikes are sucking money out of the economy. I'm paying more for my mortgage, so that means I've got less to spend in the shop. The shopkeeper doesn't make any money because I'm sitting at home eating my baked beans on toast rather than going to a fancy restaurant. And that cycle slows the economy down, causes that restaurateur to not hire any more staff or to shut down one day a week or whatever the case may be. And that causes the economy to slow down.
Well, what that tells me then is that the RBA is going to say we need to see more time of these high interest rates to see whether or not they are high enough to suck the oxygen out of the system over time. In other words, we need to see unemployment, the number kick up a bit, whether it's through more people coming into Australia or a combination of that and some people may be losing their jobs, perhaps. We need to see this unemployment number increase. And you need, as you said earlier on, we use the word crush, I like to use the word break. Yeah. We need to see something get broken.
Unfortunately, I think that's right. I think you do need to see pain in the streets almost. That it's not much fun. We're already well aware that from a lot of mortgage holders that have been on the variable rate and they've been hit 10 times in a row. Every time the RBA's hiked, they've been forking out more money. They're the ones that are under a lot of financial pressure. And and I think you're right. This is the really curious thing about what the RBA will be thinking.
As opposed to what they're saying.
Correct. What they're thinking is that we have a lot of information coming through that the economy is slowing down. And look, their economic models are, they're not foolproof, and that's not being unkind, but different things happen from time to time. But their models would be telling them that inflation will be falling. Their models are telling them that we consumers are spending less. And in fact, Dr. Lowe, the RBA governor, gave a speech 2.5 weeks ago where he actually went into a great deal of detail about household spending, which is, don't forget, well over 50% of Australian GDP. And he said that it's actually starting to fall. Retail sales, in dollar terms, are starting to fall. They're lower now than they were in September last year. And that's that effect, that cumulative effect of these 350 basis points of rate hikes biting on where we can spend our money.
So we're going to go through a checklist as to see whether or not we are going to get a rate increase at the RBA meeting for May. But just before we do that, I think one of the outcomes of this discussion, Steve, is that whatever happens tomorrow on Tuesday, these rate increases, the 350 basis points of increases we've had so far, are going to stay here for a while because inflation is still stubborn, and we've got a long way to go from 7% down to 2 to 3%, and we just got to wait and see how long it takes to actually to break something or crush some part of the economy.
Yeah.
And
I agree.
We're going to see unemployment number change.
Look, and I think that's a roundabout way of saying we ain't going to see a rate cut anytime soon. It's not even sensible to speculate about it. You know, they're not going to cut rates. I think there's a good saying in economics: if there is a move from the RBA, it'll be up, not down.
Yep.
But as we just discussed, you know, they sort of probably got enough information for them to be on hold. And if we look back at history, because it's been since 1990, since they've announced interest rate increases, there are often periods when rates are on hold for 6, 8, 10, 12 months. So we've only had 1 month on hold, probably 2 tomorrow, but it's not impossible to think that when we get to, say, December, we haven't had a change in interest rates from where they are today. The RBA will be, maybe will we, won't we, will we, won't we, sort of thing. But on balance, they'll just sit, let them go, let the economy slow down, and hope that inflation momentum that we saw going in the right direction in the March quarter goes the same direction in June, September and December. That's their hope. But we could be in for a period of 6, 9, 12 months where rates are on hold.
Yeah, I'm saying 9 months. So let's look at the board.
Look at the board. Gosh, the famous monetary policy checklist, Mark. Look, and we've got to go through these list of things. For the moment, the GDP numbers, we've got annual growth of 2.7%. That's a good number. We're growing reasonable. It's down from where we were, but neutral. Inflation, we've spoken about that. Way too high. If that was the only indicator that the RBA was looking at, and there are more, they'd be hiking and hiking and hiking. 7's just
But it has the most weight on it. It is the most important
It is
indicator.
the most important thing. The labour market. Now, this is a curious one. I'll put that in between tightening, 3.5 unemployment's nice and low. Wages are picking up. They're not a problem. But then we've got things like job ads turning down. So it's not quite into neutral yet. And these top things are the most important in this checklist. I'll just want to repeat that.
And just so just for the sake of when you say labour market, you mean unemployment.
Unemployment in particular.
Yeah.
Here's the wages number. I'll put that in neutral because wages growth is 3.3%. The Reserve Bank have said that is consistent with their 2 to 3% inflation target. So that's neutral. 3.3% wage growth. Yep, that's happy days if we can keep that going. International economy. Well, the Fed is still hiking. The European Central Bank is still hiking. So I'll move that to between neutral and easing. But we do know, as we discussed, the world economy is weakening. Commodity prices are coming down. That's probably neutral to slightly easing. House prices have started going up. I'm just going to stick that in neutral. They fell about 9% from the peak in early 2022 to early 2023. And the increase is 0.5% a month. Could be a dead cat bounce, could be just not a lot of stock and the big increase in immigration that's caused that. But I don't think the RBA would be worried on the up or the downside on house prices.
So what's interesting about that is that our mates at Westpac are saying they've reviewed their 15% from trough to peak, or peak to trough, reduction now back down to 10%. So they're sort of taking a view. We don't think at this stage that house prices are going to fall too much more. And
just as I was coming in here, CBA, who've got the biggest mortgage book in Australia, revised their house price view. I think we're looking at something like minus 15%, if I remember correctly. They're now saying during 2023, house prices slightly up. During 2024, plus 5%.
That's interesting.
CBA have now, they're not super strong, but we've seen the worst, put it that way.
5% is not a bad sustainable
Not a bad
rate.
If we could get that, that'd be a nice thing. Retail sales, I'm moving that between neutral and easing. They have slowed a lot, but we consumers we're still spending. And while the heat's come out of it, we're not quite yet capitulating. So that's probably more
neutral. Do you think
neutral.
people are using credit cards? Is there any credit cards? Is there any data out to say there's a greater use of credit cards now?
There is data, but it's not showing much. What's happening, and they're running down their savings. Remember during the pandemic, and we heard the RBA governor...
250 billion.
going on about how much money people squirreled away their money, or they just couldn't spend it. We're stuck at home watching Netflix, being locked at home rather than now that we've gone out, they're running down their savings, which actually helps support consumer spending. Even though it's slowed down, it's not fallen off a cliff. Consumer sentiment, weak. We consumers are feeling glum. Cost of living, higher interest rates, it's a pretty simple one. Building approvals. Now, this is what causing me some concern. I'll put that in the easing side because building approvals are at their lowest level in a decade.
They dropped off a cliff.
And part of that was a bring forward, because remember that one of the stimulus measures that Mr. Frydenberg quite rightly brought in during the pandemic was a bring forward of construction. You go outside and build, so it wasn't quite impacted like many other sectors. So we had a bring forward of housing construction. So now we've got a big slump in housing construction. The other thing that worries me is a lot of building companies are going belly up. They've got the fixed price contracts. Cost of buildings gone up a lot. Availability of tradies, very, very tough. So that says to me that we're not going to build a lot of houses. Is it bad for GDP because we're not building as many houses as we need.
And is there much data out there to say, in terms of the current stock of construction contracts or buildings that are being currently built, when does that stop? In other, because there was a big, as you said, there was a big build up of new business, new building approvals. That
in 21-22
became jobs for tradies, etc., around the country.
Yep.
And then, do we know when that's going to run down?
It's still got a bit of momentum because it takes, as we know, to build a dwelling, and this includes high-rise dwellings. On average, it takes between 12 and 18 months for a bit of dirt to turn into a finished dwelling where someone can move into, because that's what matters. So we've probably got, what do we call it, completions, dwelling completions data. The ABS, Bureau of Statistics, have them as well. They're still quite resilient. They've just tilted down a little bit,
right,
but they lag behind building approvals by 3/4, by about 9 months.
Right.
So it'll be later this year that we'll get that number declining.
Yeah, sometimes toward the end of this year, we're going to start to see the impact of that.
Correct.
And that'll affect spending.
Correct. So the next couple of items, business investment, doing well. I'll put that in neutral. Still positive. Businesses are ramping up their investment on IT, on equipment, machinery, even things like warehouses and stuff. So there's a bit not booming. So I wouldn't put that in the tightening case because we want to see some business investment, but it's sort of neutral. It's fine. RBA is not worried about it. It's not weakening. Same with business confidence. The good old NAB survey's got business confidence pretty resilient. We consumers are feeling gloomy. Businesses are feeling okay. Commodity prices, they've come off. I'm going to put that in neutral too. So I've got a lot of neutral buttons down the middle here. Commodity prices have come off, but they're still quite high. When we were saying before that oil's $80 a barrel, a couple of years ago it was 60. So they're higher than they were a few years ago, even though they've come off their height. Same with iron ore, so important to the Australian economy. Still about $115 a tonne. The Fortescue Minerals, BHP, Rio, their cost of production is about $25-30 a tonne. They're making a truckload of cash. So they've come off the boil, but they're still okay. Stock market, resilient. It's been choppy every morning. I wake up and look at the Dow. It's up 100, down 200, whatever, but it's actually neutral. Not an important thing for the RBA.
Except in wealth.
Except if it crashes.
Except when you feel wealthy or don't feel wealthy.
Correct. You look at your super and think, oh, gee, I've made a lot of money this year. It can have a sentiment effect, but it's sort of not, and unless it crashes, 20% in the month or 20% in the day, they generally don't look at it. It's worth having on our monetary policy checklist more for when if it goes up and down 1% a month, who cares? It's when these get these big booms or the big busts that occur, which happen from time to time.
Which is happening. And
the current rates, I'm going to put them in I'm going to move them towards between neutral and easing because they are tight, as we've discussed many times. 3.6% official cash rate, mortgage rates close to 6%. That's not a low interest rate anymore. They were a year and a half ago. They're not now. So, do they need to keep hiking and hiking and hiking, as we've just discussed? Probably not. So I look down my checklist. The important things, there's a couple here that point to tightening or neutral. Things that are not unimportant, but not the dominant things are on the easing side, but most of them down the middle. So my monetary policy checklist is shouting at me, on hold when the RBA meets tomorrow.
Okay, so on hold, but importantly, don't expect rate reductions.
Oh, no rate
for a while.
Until these are the two buttons that have to move to at least neutral, or be erring towards neutral. We're not going to get a rate cut.
So what is it?
We won't see one until inflation falls.
So Steve, what is it that Westpac some of the banks are saying, I think
Yeah.
CBA as well. I think CBA is sort of saying, or was saying at least, late this year, early next year, some rate reductions. Westpac's saying later in 2024, but a lot of them, the market, the general market, the money markets are sort of saying late this year, some rate reductions. I guess that's 8 months away, or 7 months away. But what's driving those conversations?
Yeah, I have an element of sympathy for those views. I think Westpac have got 1 or 2 more hikes, and then I think they've got 7
rate reductions.
Rate cuts in 24, and then maybe just drifting into 25 a little bit. So less than 2 years away from now. So it's good. It's a good forecast. They are looking at the fact that the economy is slowing down. I think they're sort of saying that, we need to squeeze, or the RBA needs to squeeze inflation out of the system. It will do so. The collateral damage of that will be higher unemployment, will be weaker economic activity. And so they're saying that when the dust settles from this carnage, putting words in their mouth, but this really tight monetary policy, when the dust settles, the RBA will say, oh, gee, we've actually got a really weak economy. Unemployment's going to be 4.5% to 5% rather than 3.5% where we are now. We'll probably have to take some of that restrictive stance of policy away. We might even have to start cutting rates. I think they're sort of anticipating that these rate hikes will work, the economy will slow down, and that when we're here in, 6 or 9 months, these buttons will be more in neutral, and then in 12 months, they'll be saying, oh, gee, inflation's all of a sudden in target, unemployment's really high, wages growth is a dead duck. They can afford to take away those 350 points of hikes that they've delivered.
And GDP is going to be
GDP will be weaker, and that the inference is that we get GDP tracking towards 1%. So it'll be interesting to see whether we get that sort of downturn.
So let's wrap this into house prices. So it would seem, and tell me if you accept this view or you are part of this view, that the only way that we're going to see house prices from where they currently are to really dip lower, for all those people think they're going to go be opportunists and go make money out of buying lower house prices. The only things that is going to create that is if we actually go into recession, wages, that unemployment kicks up from 3.5% to 4.5%, and GDP sort of drops right back, perhaps getting close to recession. There's all the pressure drops off on wages, etc., and the international economy also continues to be stridently resistant against reducing inflation. Are they the sorts of things that you expect to see?
The moving parts in house prices are many, and they have a different effect from time to time. For me, if house prices were to then resume a sharp fall, and don't forget they did fall 9% in a year. That's a pretty chunky decline, So $1 million house became 900,000, give or take. You lost 100,000 on a $1 million property.
You didn't lose, but you lost value.
You lost wealth, paper wealth. Now that's significant. Now, for that to restart and to drop another 9%, so we get a fall close to 15, 18.
The Chris Joy scenario.
Yeah. I think we need a couple of things to happen. The most important one, I think, is unemployment. If unemployment rate goes up a bit, that's fine. If it goes up a lot, then house prices and the economy more generally are in big trouble. Because when you think about it, and this is sort of, I like the way this is often put to me. If you've got a small mortgage, so you're doing fine, but you lose your job, it's really hard to pay even a small mortgage.
Correct.
If you've got, inverted commas, a big mortgage, but I've got my job, I can adjust my spending because I can redirect my spending away from, what do we say, nice to do things, eating out, fancy holidays and good bottles of wine, to cheap bottles of wine and sort of staying at home. And I'll make my repayments. And we Australians, because we have our love affair with housing, we're going to make our repayments. Unless we absolutely have dire circumstances. Dire circumstances are higher unemployment. So to me, the critical issue for house prices is unemployment. And again, when we look at this last couple of months and that little bit of an upturn, 0.5% per month in the last 2 months, so not huge. Why? Unemployment's been low. We've had this big influx of population through students coming back here and immigration, skilled migration. We've heard a lot about that in the media the last little while, and not much supply. Supply and demand do work. Interest rates, of course they matter. And but the dominant thing to me is just huge demand, not much supply. I've got a job, and while I might be swearing and cursing that the interest rates have gone up, hey, I can still buy a house. Investors also, there's a bit of evidence that came through in the CBA's internal data, which came out last week. They were saying that investor demand has come up because investors saying, well, I can still negative gear my property. That law's not going to change ever. If I do buy an investment property, because the vacancy rates are so low, I'll rent it out really quickly, so I won't have this asset that's sort of not earning any rental income. And the rental charge might be bad for renters, but for an investor, thinking, gee, I can get a really decent rental yield on this property.
And increases as well.
So I'm going to do it.
And there's not likely...
So investors have stepped back. And
there's hardly likely to be a change in that in the next couple of years. The
rental market's tight as a drum. Yeah.
Because it just takes a long time to resupply the market. So, Steve, just in finishing, it seems to me that this unusual sequence of events that we've experienced over the last 3-4 years, starting from when COVID started and all the liquidity put in the system and interest rates going down where they went to, now interest rates going back up to where they are now, and it's this sort of roller coaster of a series of events. One of the things that's come out of that is a really clear correlation between the unemployment number and house prices.
I think that's been the standout issue.
Never
to me.
have I really noticed it before.
Agree. I put my hand up and agree.
It's a new phenomenon. Maybe it was always a phenomenon, but it's a new phenomenon for at least people like you and I who are very close to these things. Because we've always correlated interest rates with house prices, but I think the new normal of correlation is actually not interest rates, but it's not as much affordability. It's more about, have I got a job, and do I need to sell the house? Because you're right. If I don't have a job, it doesn't matter how low my interest rate is.
Yeah, interest rates could be zero. I can't pay. I can't make payments. Yeah.
And what's really important around that is because right now we're spending what we save too as well. So
savings are starting to come down.
We've got nothing to fall back on.
Correct.
So the real thing, you might have to move up your chart here. You might have to move labour market a little ahead of GDP, perhaps.
Yeah.
So inflation and GDP, inflation and labour market or unemployment are going to be neck and neck.
They will be, and we mentioned the review of the Reserve Bank that the Treasurer Jim Chalmers announced just recently. One of the other things is that even though we've got the 2 to 3% inflation target locked in, they're saying that the new Reserve Bank board will have a greater emphasis on unemployment.
Yeah.
So when you're hiking rates, Reserve Bank, okay, meet your inflation target, that's fine, that hasn't changed, but keep an eye on the unemployment rate because you don't want the unemployment rate to skyrocket by over hiking interest rates. Now, to me, there's still a little bit of a dilemma about, well, what if inflation's at 4% and unemployment's going up? Do you hike or do you cut? So they've still got a dilemma. It makes it a little bit harder for the Reserve Bank to function. However, at the end of the day, you don't want high unemployment. Nobody wants that. It's bad for society and it's bad for business because if people are unemployed, they don't buy a house, they don't spend, and the economy weakens.
Well, I'm going to finish on one thing. You know what I reckon? I agree with you, but I think this too. It's going to be a massive problem because unless they review the inflation number and what is considered to be full employment or a new unemployment number. So if someone wants inflation to be, so if someone wants unemployment to be around 3.5%, then maybe you've got to review the inflation number to some other number, 3 to 4%.
Yep.
Because I think it's just going to be too hard to achieve both.
And they're often conflicting things.
They are conflicting.
You normally get low inflation with high unemployment.
Correct.
And when unemployment's very low, like we're seeing now, as we're saying, 49-year low for the unemployment rate, that is one reason, even though wages weren't booming, but it was one reason why we had this inflation spike. There were many reasons. Inflation didn't go to 7% or 7.8% because unemployment was 5%. It went there because unemployment went to 3.4 at the low point. Yes. No one could find a worker.
Yeah, so, and I reckon it was worse than 3.4.
I agree with you.
Because,
correct.
that's a number that came out, but it's a sort of fictional number in terms of how it's calculated.
A participation boom too, which compounded the tightness of the labour market.
So I think what would be good, what I would have liked to see come out of the review of the Reserve Bank decision-making process is for them to sort of say, okay, let's reset a few things. Let's say we would like to have an official cash rate an inflation number and an unemployment number all around about the same number.
Yeah.
You know what I'm saying?
Three, and three.
Or like four and four or something, you know what I mean?
That's not a bad idea, Mark.
You know
Maybe I'll have a chat to Jim Chalmers and
I'm
say,
serious.
mate, no, that is actually not a bad thing. And GDP growth at 3.
Yeah.
So in fact, you know, if I had my Harry Potter magic wand on the economy, if we could grow the economy at 3% in real terms per year, the unemployment rate was at 3%, inflation was at 3%, and interest rates hovered around 3%, just to use that example. That'd be a pretty good economy. That'd be a bloody good economy.
Well, that's sort of, you know, your Goldilocks position.
It is Goldilocks, yes.
But that's what, to me, that's what's come out of this whole series of events.
Yeah.
That's what I reckon.
Yep. It's not a bad idea.
So let's talk to Jim.
Let's give him a call.
See you, mate.
See you.